This is GILTI Conscience, casual discussions on transfer pricing, tax treaties, and related topics. A podcast from Carden that invites thought leaders and industry experts to discuss pressing transfer pricing issues, international tax reform efforts, and tax administration trends. We also dig into the innovative approaches companies are using to navigate the international tax environment and address the obligation everyone loves to hate. Now your hosts, Carden partners David Farhat and Nate Carden.
Hey everyone, welcome back to another episode of GILTI Conscience. As always, Nate Carden here with David Farhat, Stefane Victor. Today we're joined by Mike Gaffney of Atlantic Global Risk, talking about tax insurance and the impact of the OECD project and my favorite topics, BEPS and DIMPI, on tax insurance and how that market works. Mike, welcome to the show.
Thanks very much. Thanks very much. Wonderful to be here.
So just to kick it off a little bit, could you tell the audience a little bit about tax insurance market and your perspective on what impact the OECD initiatives have had on it?
Sure. I think the product tax insurance is basically there to deal with uncertainty, right, in the tax law, where everyone believes that they're taking the correct position, right? They probably have gone out and gotten some advice from quality firms like yourself. And nonetheless, depending on what that level of comfort is, it's not metaphysical certitude. It's not 100% covered, right? So every year, the tax director and the CFO have their hands shaking as they attest under Sarbanes-Oxley that their effective tax rate and their books and records are accurate. Nonetheless, even with the should opinion, there is some risk. We've seen in court over the years, the IRS often wins cases where the taxpayer has been well advised and they have strong opinions. Nonetheless, that's not metaphysical certitude that we're seeking. The tax insurance product is there effectively as a risk transfer mechanism, right? For a premium, depending on the ultimate position that is being covered, takes that, whatever you want to say, a should opinion or a more likely than not, whatever it is, for a premium, of course, there's a cost to it. For that premium, it basically shifts the downside liability of a covered tax position from the taxpayer's financial records to the highly rated insurance company, right? That's sort of what the product does. And going back to my history on Wall Street, it reminds you of early days of cross-border derivatives and securities lending, where effectively you're trying to figure out a way to shift risks, where you still obviously have an obligation where you hold one position, you're entering into a second position to offset the risk. And that's effectively what tax insurance is doing. Obviously, you still have your contentious issue as a taxpayer with the government in question, whether that's the IRS, the CRA, the HMRC. What you're doing is entering into a contract with a second party, an insurance company, through the use of an insurance broker like Atlantic Global Risk. And through that, you're shifting the risk if and when that tax position turns pear-shaped, as they would say in England. That's what the product is there to cover.
So you're going to transfer risk, you got to price risk. And one of the frequent themes that we have is that it seems like countries around the world are moving apart rather than together in the way they apply the tax rules. No more so than in areas like transfer pricing and the ownership of assets and the recognition of risk, particularly after the BEPS project. How is that changing? How these risks get priced, or even what deals you can do?
I think what it's doing is focusing more on, maybe there's always been historic disagreements between tax authorities. I think what the BEPS project has done is elevated that to a policy level, where, in my view, looking at it, it looks like a lot of the BEPS program or the BEPS 15 initiatives, and I try to keep them straight by retired New York Yankees numbers. So I think the one that was underutilized most was the Babe Ruth one, which you would think that would be the top, but that's the CFC rules, right? And why is that, in my personal view? Mainly the targets were U.S. multinationals, right? It was all about the residual, right? And you could solve the residual with a adequately policed CFC regime. And I think apparently the U.S. thought they had one. Other jurisdictions may not have agreed because they obviously did not go back and read the 1962 committee report, where in the first version, the House had a version that would basically tax as a category of subpart F certain income from the exploitation of intangibles, whatever the hell, in 1962. It hopped over to the Senate. Somehow that fell out. And really, I think the argument in BEPS, the main argument was all about who gets that residual, right? And I think the other big argument, which one was, I think, 6, which I guess is Joe Torre or Roy White, depending what era of the Yankees you think about. But that's about access to treaties, right? Yeah, I think the problem with the BEPS is it overly focused on, from a treaty perspective on whether you could save one level of tax but still have higher level of tax at home, and confuse the inbound investment aspect, promoting the inbound investment, which tax treaties have a leg in doing, with anything that has to do with a tax savings, and then basically say tax savings are themselves some sort of abuse of the rules. So to me, the beneficial ownership, and we have seen tax insurance products to deal with this. So the shift of the BEPS analysis was to what is the substance. I used to think of substance as being something that's required in a transaction between related parties or unrelated parties. I think what the BEPS program has done is change substance from the transaction itself to the substance that's in that box in your order.
Gosh, I was about to say, let me interrupt you a little bit.
Sure,
The first thing is, as a Baltimore guy, it makes me
Yeah.
really uncomfortable with Beps and the Yankees. Just had
Yeah,
to throw had to throw that out there.
I was going to say I will never think of Dempy again without thinking of Yogi Berra. So this is
Yes,
excellent.
it's
8, 9,
problematic.
10. 8, 9, 10, right? You got Yogi, you got Roger Maris, and you got the Scooter Phil Rizzuto. That's it.
I love
Listen,
that cartoon.
this is entirely too much Yankee talk for a Baltimore kid. But kind of going back to your substance point, Mike,
Yeah.
if you could just unpack that a little
Sure.
bit for the listeners to say,
Sure.
kind of going from the substance of the transaction to the substance of that box.
Yes.
If you can kind of describe and unpack that, and I think within that we can get to where we're seeing a lot of the disconnect between jurisdictions and where some of the problems come up.
Sure, sure. And I was going down the little hole of the U.S. active financing exception. And to me, that was my experience, right? Is the first time that you need to have substance in a box, right? But since 1998, it's been there saying you need kind of two things in that CFC in order to earn deferral, right? And there's an objective test and a subjective test. It's a substantial activity test and a predominantly engaged test. One test, the objective test, goes to the box on the org chart, the entity. And effectively, shorthand way to say it, if that's a regulated entity, a financial services entity in the jurisdiction that it's operating in, you pass that test. That's the objective test. You go get a license, you're good. The second test, and you need to meet this in order to get deferral of the income in that box, is the employees in that entity need to perform the substantial activities that generate the income. And I think that's sort of where the rubber hit the road. I think up to that point, without the substantial activity component, I think there was a view among non-FS people that, hey, this is really great. We can stick a box in low tax jurisdictions and jam all sorts of passive type income into that box. As it turned out, you cannot, until you have employees sitting in that entity that actually generate the income. And so that, to me, that's why what I saw where the BEPS program is going on this, I was saying, okay, my view, you need to have humans in that box. And fast forward to the BEPS, post the 2015, finalization of the program, and as it's been rolled out, not just along the OECD, but the European Union picking it up, it seems like a lot of the European jurisdictions are saying, okay, we have it.
One of the things we've talked about here is we had BEPS 1.0 just
Yep.
in 2015. That was not very long ago. We're just getting comfortable with that, and they're already talking about BEPS 2.0, right? And kind of unpacking what you said, it seems like it's hard to kind of pinpoint the policy reasons for some of these changes. How do you kind of evolve around those changes with when you're writing policies, when you're looking at things that go forward and dealing with that kind of risk?
Yeah, I think the most important part is deciding what the covered tax position that's insured is, right? And for what period of time and for what amount. And maybe taking, the covered tax position is key. Like in the analysis we just went through, is Holdco eligible for article whatever of the tax treaty, right? That's the legal question. That's probably what they have an opinion supporting. So in essence, the tax, the policy is covering that. The period it's covering would be, for the year it's put in place, right? Normally, a lot of tax insurance policies in the U.S. cover a 7-year period. However, that's thrown out of the fact that a lot of times they're associated with merger and acquisition transactions, where the buyer is inheriting, the tax life of the subsidiary they're purchasing. right? So the forward-looking BEPS one is a little different, right? You're going to need an attestation every year. There may be a premium every year based on year-by-year analysis, because you're going to have to, the thing is, you're going to have on one side of the boat, if you will, is the taxpayer, the insurance company that accepts the risk. They won't accept it unless they believe it, right? And also, you would think, the financial accounting firm that's attesting to the financial statements of the taxpayer, right? So people are in the same direction. On the other side of the boat is potentially the adverse tax authority, right? So I think the idea on a forward-looking policy, and it's a little more nuanced because you generally have to be very specific. Actually, you have to be very specific with the cover tax position for any policy, right? But for a year-by-year policy going forward, this, what we've seen is sort of you can pay all at once for a period of time. Why would, if I was buying it, I said, why would I? It's like I might sell this thing next year, right? And so I think the idea is like the expectation is every year you renew it.
Trying to make connections with what we've discussed so far and what areas of subjectivity that tax insurance might cover. Would it be the subjective portion of the economic substance, I guess, analysis that would that tax insurance would be especially fitting for? So like, a determination of the significance of employee functions at a specific CFC?
I think that would be the key. I think you'd probably want to cover both, right? Because the cover tax position would probably want to cover both. And to your point, I think you nailed it, Stefan. I mean, the hard issue is the subjective piece. The objective one is fairly simple, but you would hate to have lost your license for a nanosecond and then have the insurance company say, well, we're not going to pay. But to answer your question, you're right. For that specific risk, you want to make sure that the attestation of the substantial activity of the employees is met on whatever basis is required in the law, right? If it's annual, is it quarterly, what is it? And you're basically going to wrap the policy around that provision in order to make sure it's the covered tax position. And then going to the other point, which is probably obvious, but bears restating, is if you're a big taxpayer and you're audited by country X, you probably have more than one issue under audit. Maybe this active financing, maybe 17 other things, right? Conduct provisions of the policy, require having grandkids now. I like to think of it is the minivan approach. The kids are in the car, they're not driving. Maybe they're in the third row of the minivan, but they're in the car, and so they need to be aware. When they say, "Are we there yet?" You basically there's conduct provision throughout the treaty. So generally speaking, as a U.S. person, if you get an IDR, the insurance company should be aware of it up front before the contract is incepted. You will generally agree, right, on how far you have to fight this thing.
I'm imagining a tax director out there listening to this, and I hear you say, "Hey, I can transfer this risk, but first I got to go through an MRI scan of my operations in order to get the thing priced. Then, when the audit's going on, I'm going to have somebody chirping over my shoulder. Then I got to worry about whether I've actually defined the tax risk correctly." This all sounds like a big hassle. What are the kinds of risks where, in your experience, like for multinational listeners out there, both FS space and non-FS space, what does it make sense to think about pursuing, and was it probably more trouble than it's worth?
I think it's really for the things that insurance, whether it's tax insurance or home insurance, is for. It's for the potentially low risk, but a huge downside, right? And we've been talking to a couple of taxpayers, again, around the same time of BEPS. We had the 2017, Tax Cut and Job Act, and some incredibly complex provisions came in there. And someone asked, "Can we get beat covered?" And I started like, "Oh my God, what's the issue?"
Every episode, someone has to do this to me, Nate. I think
it's
a part of play.
We didn't warn you. Don't say beat.
Right. And the thing is, well, initially that seems too complicated because there's 19,000 factors to get into a daily calculation. If it's still a monthly calculation, just to figure out whether or not the taxpayer is in the 2% bucket or the 3% bucket, depending if they're financial services or not. And it's like, okay, like forget about it. That would be so difficult to insure. It's a difficult calculation. Like, what are you really worried about? We've had discussions that it boils down to, there may be the way the business is structured. There's really one significant type of payment, or maybe it's not a payment. Maybe it's an allocation of revenue. Yeah, maybe there's one flow, right, that you have an opinion, right, that's a very high level. Nonetheless, if that's wrong, you pull that thread out, all of a sudden you're not under the 2 or 3% threshold anymore. All of a sudden you're a beat taxpayer, right? And because you had a should opinion, jumping over to ASC 740, you haven't felt the need to put up any financial statement reserve. So you haven't self-insured any amount, right? Or maybe you've self-insured for some amount that you'd be willing to settle on, which again is probably a de minimis amount because you don't feel like you're subject to the beat at all. So why would you reserve? So to me, it's like, and obviously it's 2022 now, so you're 4 or 5 years into this calculation, and if every year, the downside of that is make up a number, losing 100 million. Now you're into $500 million, right? Could you get that effectively, not the 9,000 calculations go into your daily beat calc that distills into an annual beat calc? Can you get that one issue that is really the critical issue insured? And I think the answer to that is yes.
Well,
right?
to go up
Yeah.
a level on that,
Yeah,
Mike,
sure.
and
Yeah.
I actually appreciate you using the beat example, surprisingly. We're seeing a lot of new taxes that look and act kind of like the beat, right?
Right.
They have the DPT, DST,
Yeah.
all of these taxes. And we've kind of talked about the impact for tax practitioners and the impact for taxpayers and multinationals out there. What does all this change look like for your industry, for the tax insurance market? How are you guys dealing with that? Because I like how you kind of walked through the beat and said, well, we may not insure whether, for beat because there's so many different factors in there, but we may be able to pick out one thing and look at that. So how has that impacted kind of what you guys do and your outlook into the future?
What we're finding is usually it's a couple of year lag. So the discussions we had, maybe it was early 2020, 2020 late, about items that we could potentially cover. And we're not really hitting the mark. We find 6 months later, 9 months later, a year later, we get a call back and say, hey, you mentioned that tax insurance might be able to cover XYZ. We're realizing now that we might have that issue, right? And a lot of times, like, well, why are you having the issue now? Right? Because that gets into what's your motivation to get the insurance, right? Is the house already on fire? The bed was on fire when I got into it, so it wasn't my fault. The insurance company will want to understand the motivation, right? And that goes into, I think, a lot of what we're discussing earlier about, the amount of information they're going to want to see in order to place a policy. But I think it's sort of like, to me, what I try to do is stay obviously involved with what's going on, and then figure out, is it insurable or not? Which will bring us back to, I think, transfer pricing, whatever we want to go there. I think transfer pricing, to me, a lot of it relates to the residual. Because the CFC rules didn't capture it, then the residual is up for grabs, so to speak, right? And to me, what we've seen, there has been transfer pricing tax insurance policies. A lot of them, at least to my knowledge, the ones I've seen, have been basically based on, which I was like, really? People care about that? Intercompany lending, right? Question one: is it actually a debt instrument? And then secondly, is the interest rate charged an arm's length rate? And so it's like, to me, it's not the big dollars. It's not the residual.
We're talking about the residual, and I think you made a great point there, kind of ensuring around that. And it seems like everything we read about with BEPS 2.0 and all of these kind of unilateral measures are tax authorities trying to go after that residual. And I think you'll have some folks argue that maybe people aren't being as principled. Well, I think we had McDonald come on and talk about kind of the arm's length standard. Say, are we sticking to the arm's length standard when we're doing that, right? Maybe we're moving away from that. So as all of these folks try to get at that residual and come up with new techniques to get at that residual and some unpredictable techniques to get after that residual, how do you guys manage that? How do you insure around that? Because if you go back to what you said, you're looking at a policy 7 years down the line, and you've got all of this evolution.
There's always a new intangible.
Yeah, exactly.
Right. One intangible you're creating is entering into a tax insurance contract, which I think is an intangible for 263 CAFE, which may be advertisable over the 7 years, but we'll put that aside. To me, it's sort of normally the insurance contract, it's for an existing tax risk that you have, right? And because it's coming out of the M&A space mainly, it's a 7-year policy for that, when you have it, so to speak, right? And then you kind of say, okay, it's a claims made policy, which means it doesn't expire in 7 years, but you have to make the claim within the 7 years. You have to nail down what the cover tax position is, right, for that period of time, right? And changes in tax law are excluded from tax insurance policies, right? Right. So I think if there's, if it's in the statute, right, and you've got maybe the tax review, that's kind of like a change of interpretation, right? You have to go through the process of a court proceeding. And I think that's part of the generally conduct rules of the tax policy. We're dealing with a couple of taxpayers that, the G in their ESG policy is like, yeah, we would prefer not to go to court. And this gets into, all right, that's not traditional because normally tax insurance is an M&A and you're selling a box in your chart and the new person's buying it. No one knows really anything. Everyone's gone. What we're seeing more is, well, we can, going back to the put option analysis for insurance contracts, you can strike a put and call because effectively, if you have a tax position that you're not overly comfortable with already, and you've got some reserves set up under ASC 740, let's say you're reserving 20% of it, right? And you're willing to, wrestle around with the IRS or tax authority A, B, or C, and if you settle at 40, you'd still kind of say, I don't want to go to court. I'll settle in the 40. Yeah, we have discussions with several clients, so you only want the insurance to kick in at 40 and above. You want to do it pari passu. How do you want to do it? Or is there a pain level at what point you would definitely go to court? If that pain level is 65, right? Then you only need to insure $1.66 and up. The premium on that's probably going to be the same because the tax issue you're insuring is the same, so the rate is the same, but the quantitude, the magnitude of the premium in pure dollar terms is much less.
The question we're dancing around here a lot is
Yeah.
the financial statement question.
Yeah.
As we move on through this, help people that are listening who
Yeah.
maybe don't have tax insurance but are thinking about it. What's sort of the income statement balance sheet geography of this, right? I get what it means to reserve for a tax position, but what happens if I insure it away?
Boy, this is, I've heard people say, oh, you can enter tax insurance and eliminate your reserve. And I was like, wow, that's interesting. I don't want to blame Fredonia again. Was that Fredonian gap? I kind of look at it as, you've got a potential liability to the IRS. We'll leave the CRA and the rest of them out of it. And I entered a contract at a different point in time, right, with a third party, where they're going to pay me, potentially, if this other thing goes pear-shaped. And I think there's a very, very narrow area. This is like I think the general rule is, there's no real offset, right, when you enter into the contract. We'll get back to when the payoff occurs, what happens. But I think in the M&A context, if the tax insurance is part of the transaction, there's a very narrow, and it's not ASC 740, I think it's the business combination, the ASC 405, blah, 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 that if it's a condition of the sale, right, you can basically net it together, so to speak. Maybe what I'll do is I'll go back after we clean this up a bit. But I think it's a very narrow subset, right? So there's a point of, the new CFO and new head of tax, that's not really available to them, right? Or a multinational looking to use the policy as a risk mitigant, right, for an existing position, that's not really available. It's sort of a narrow little alley having nothing to do with ASC 740 tax or necessarily insurance. It's this narrow part of the business combination, and because then you're buying something that has the tax insurance linked to this tax issue. And that's I think it's a very narrow subset. The general rule is like, hey, you owe the IRS potentially 100 here. You're going to pay, company X 5. you notice how the premium keeps going up in these? I want to make sure. It
I,
started at 2.
I'm
Now I'm up
noticing,
to 5.
yeah.
I'm up to 5. But yeah, we're up to DiMaggio. We're trying to get to Mickey Mantle. Yeah. But yeah, we're so 5%, and basically, you say, okay, what do you do there, right? My view, and toying with writing a long article on this, but you bought something, you know, you effectively acquired, if it wasn't called an insurance contract, it economically looks like a put option, right? And your premium's 5, right? And if things flip, right, you put that to the insurance company and you get 100, right? The IRS doesn't get any of that, right? To me, it's like you still have an obligation to pay the government, right? And then you have this other thing over here, right? On day one, it seems like, to me, question is it deductible year one? I'm like, I don't think so. Arthur Miller Dance Studio and all that stuff. Yeah, you got something that you have 7 years. Is it intangible? I would think it's an intangible, right? It's a contract, right? And you sit there like, okay, so I can amortize it over 15 years. Well, it's only a 7-year contract. I would think you probably amortize it over 7. That's my own sort of analysis, which for better or worse coincides with generally how an insurance company would pick the premium up, right? Not that you need symmetry in the world, but isn't that
Hmm.
lovely? It kind of works like that. If and when year 5 you lose in court, you say, okay, great. it, in the quarter, you basically you owe the IRS money. It would be great to confirm because you've been playing ball with the insurance company. They're in the minivan, all that good stuff. They're aware of everything, and in the same quarter, right, this thing you paid 5 for in year 1 way back 5%, still at 5. Uh, you know, it all of a sudden you have an insurance asset, right, that leaps and expands and goes to 100, right? Magically in that quarter, you have basically you're able to use that 100 you've created, right, to offset the liability you have to the IRS, right? So it's kind of nice, right? I mean, that's to me how it works. I don't think you can. I know there's people
Yeah.
saying you could. Yeah, I've heard this. I'm like, I don't think so. I mean, I did pass the CPA exam in 1982, but I think my official that CPA at this point stands for can't pass again, which I'm sure. But I don't think the fundamentals have changed that much, right? You paid a nickel. It's hard to figure out how you can eliminate a
Hmm.
reserve that might be 25, right? It's like
Well,
that'd be
for all
great.
those
I would love it.
all those anthropocentric changers out there that we're hoping they get rid of the reserves, they're now really disappointing.
So, Mike, as we're coming into time,
Sure,
believe it or not, time flies when you're having fun.
we
Any
are.
final thoughts before we wrap up this one?
All right, let's see. I think just it's something to me the way I think of the product, right? It's a tool for advisors to have, right, and for taxpayers to know about, right? I think what we're doing a lot of the last couple of years is just awareness, like and the model of our firm and the other brokers is our business model. We don't get paid until the policy incepts. So I probably spend a lot of my time, way more than half, between talking to people what the product could do versus, hey, we have a live risk, right? And then our process is we will hear the risk, right? We will generally within a week, 10 days, come back with a non-binding indication, right? So it's the classic, tell us a little bit about the risk, right? You've got a should opinion from X, right? We'll go talk to the underwriters, 20 odd underwriters. 10 might be, they don't want that kind of risk. So you're down to 10. The other 10 say, well, if what you're telling me is correct, right, the amount is this, they have a should opinion from firm XYZ, right? We've seen this risk before. Our pricing, depending when we get to underwriting, is a range. It's 3 to 4%. It's 4 to 4.5, right? Then we can give a report to the client, say, hey, we talked to 20 clients. Here's your non-binding indication report, right? We got quotes from 6 of the 10 demurred, the other 10, we would say exclude these 4 because they have exclusions that are critical, right? We'll give them our recommendation, right? At the end, we'll explain which one. Now, do you want to go through underwriting or not, right? And at that point, that's the first time the client writes a check. And then they go through underwriting. And if it finally binds, then they write the big policy check, right? Was they up to 7% by now? I forget. Yeah, 5%, 4%, whatever it is, And then the policy incepts, when everyone agrees, and off they go. Everyone sits there and waits for the 7 years or whatever term it is to expire, and you figure out whether you've got to, whether you have the put option gets put to the insurance company, or whether or not, in hindsight, I wasted my 5%, right? Yeah.
Hey, look, life insurance, I didn't die last year. I'm not complaining about it. It wasn't a waste. But, look,
Yeah.
you had me you had me wanting your job until I heard you don't get paid until the policy's in place. But it's still a fascinating market. Thanks for talking to us about it.
At a minimum, it wards off dementia. That's my main point. Coming up on age 63, you got to keep going. You got to keep thinking. That's it.
As always, a pleasure, Mike. Thanks.
Yes, we'll see you soon.
Yes.
Take care.
Okay.
Cheers.
Thanks for coming on. This has been Guilty Conscience.
Thank you for joining us for today's episode of Guilty Conscience. If you like what you're hearing, be sure to subscribe in your favorite podcast app so you don't miss any future conversations. Skadden's tax team is recognized globally for providing clients with creative and innovative solutions to their most pressing transactional, planning, and controversy challenges. Additional information about Skadden can be found at skadden.com.